It's like, it's the Mark Twain, reports of my death were greatly exaggerated. Well, it turns out reports of the death of SaaS and software were greatly exaggerated, right? If you are a good CEO, and Dev is an extraordinarily good CEO, just like the Cliff story there, because I noticed Cliff, he didn't say, oh, it was all just AI. We got our shit together. We did a whole bunch of things. We raised our expectations. We said, hey, we're the leader in a big market. Let's make stuff happen. And, and if at that point you're valued at 7 times and then you beat plan even by a little bit, you get that kind of bounce. That's what happened here.
Cliff, when you see this and Monday getting hit for being, a couple of percentage points off, again, I would never ask on timing or anything quite that ludicrous, but you go like, yeah, that's an arena I want to be in. Or do you sit and watch Cheeky Pint with the Collisons and go, that's the fucking arena I want to be in, sitting drinking a non-alcoholic beer with the founder of Cognition, doing a handstand with Vlad, enjoying the wonderful splendor of the private market?
I still like my beers alcoholic. I haven't followed that trend, but
I love it.
I think it comes. I mean, yeah. There's a lot less scrutiny as a private company, but as a late stage private company with the likes of all the big cats that are playing in public markets, already invested in us and continuing to do so, our reporting obligations and our expectations to beat and raise are pretty much the same. So it does get me thinking, like, what is the real difference? And then I think to your point that you've made on previous podcasts, the public markets are valuing companies a lot higher. So when the public markets were valuing companies lower than the private markets, you were kind of like, well, whatever, whenever. But now at a lot higher marks, it is appealing. It is becoming more appealing to tend to private.
In the show, we actually mentioned you. You probably heard it, sorry. Where we were like, Figma goes out, Jason's, but like Figma goes out, sees the pop. And if I were you, I'd be going back to the team going like, let's Forrest Gump this one. Like, we should go out now. Let's run for it.
We're gearing up to be ready to IPO. We want to be an IPO ready company. You mentioned Zoom. We brought in Kelly, who led their IPO, and she's been a fantastic addition to the team. She was their CFO. So our goal is to be ready. When we actually go out is another question, but yeah, we're gearing up to be an IPO ready company.
Can I ask a question we've talked about on this show a bit? You have $1 billion in cash. You're profitable or cash flow positive. I don't care which one, probably both.
Nice.
You're able to do tender offers for your employees and provide liquidity. And for whoever of your early stage investors want out, you can probably flip their shares. Why IPO?
I'd love them to sell more shares because it has helped solve my problem right now of not having enough sell side.
Yeah. So why at a meta level, why IPO, right? You have, and even M&A probably isn't a reason on its own, right? Unless you want to buy something for $10 billion. Why would you IPO?
Yeah, I mean, that's the question we've always asked ourselves. And I think there's 3 key points. There's availability to capital, which we have access to. I think it's probably liquidity, and there are restrictions, particularly around employee liquidity and what you can do in the US and whatnot around that piece. And so we do believe we're 13 years old as a company. Our employees should have liquidity. They've created all this value. How can we make it easy for them to access that wealth that's built up? And while annual secondaries are a mechanism for that, it's pretty janky, and particularly in some jurisdictions, it's downright impossible. So that's probably the biggest one. Yeah, as you also get a bit more publicity. Personally, we don't want to be more in the public eye.